So if you're in crypto, 2025 has been, well, it's been a rough ride, hasn't it? But what if this market crash and this huge wave of new regulations aren't separate things? What if they're actually two sides of the same coin? Today, we're going to connect those dots, and we'll start with a really powerful move you can make right now.
Yeah, this feeling is probably a little too familiar this year. You open your app and it's just red, red, and more red. It's so easy to feel kind of helpless when that happens. But what if those losses weren't just a problem? What if they were an opportunity in disguise?
I'm serious. Tucked away inside those falling numbers is a powerful financial tool that a ton of investors, especially in crypto, completely overlook. We're going to start right there, with your portfolio, before we zoom way out to see the massive picture that's unfolding.
Look, there's no way to sugarcoat it. 2025 has been a classic crypto roller coaster. After the absolutely insane highs we saw at the end of 2024, we've hit a pretty stomach-dropping dip. And that creates a lot of anxiety, for sure. But as we're about to see, it also creates some pretty amazing opportunities for anyone who knows where to look.
Okay, so let's talk about this secret weapon. What is it? It's a strategy that can turn your on-paper losses into actual, tangible savings in your pocket. It's called tax loss harvesting.
So here's the key thing you gotta understand. For tax purposes, a loss doesn't really exist until you make it official. You can't just tell the IRS, hey, my portfolio's down. It doesn't work that way. You have to intentionally sell that asset to realize the loss. That's when you can actually use it to your advantage.
And the impact? Oh, it's staggering. Just look at this table. Let's say you've got $50,000 in capital gains somewhere else. Ouch. But you're also holding some coin that's down $22,000. Without this strategy, you pay tax on the full $50K. But if you sell that losing asset, you realize the loss, and bam, your taxable income drops to just $28,000. That is a massive difference in your tax bill. And the process is actually pretty straightforward. First, you just identify which of your holdings are down. Second, you sell them before the tax year ends to make that loss official. And finally, you use that loss to cancel out your capital gains. And hey, if your losses are bigger than your gains, you can even use up to $3,000 to lower your regular income. It's a win-win.
Now, this is where things get really interesting for crypto investors. With stocks, there's this annoying thing called the wash sale rule. It stops you from selling for a tax loss and then immediately buying the same stock back. You have to wait 30 days. But for now, the IRS sees crypto as property, not a security. And what does that mean? No wash sale rule. You could, in theory, sell to harvest the loss and buy it right back.
But there's one really important catch here. It's called the economic substance doctrine. Think of it as the IRS's don't try to be cute rule. If you do a transaction that has no real purpose other than dodging taxes, like selling and rebuying in the same second, they can just wave their magic wand and say, nope, doesn't count. So it's always smarter to tie the sale to a real portfolio decision, like rebalancing.
So why is this strategy so important right now? Let's zoom out a bit and understand the huge forces that are driving this market downturn, the same forces creating all these tax loss opportunities in the first place.
It's really kind of a perfect storm. You've got these big macroeconomic pressures, inflation, tariffs, that are making investors jittery. Then, within crypto itself, after that incredible run Bitcoin had past 100 grand, a major correction was almost guaranteed. And of course, you've had big scandals, like the whole Libra project collapsing in Argentina, that have really shaken people's confidence. But it's that last point, regulatory uncertainty, that's the perfect bridge to where we're going next.
Because that uncertainty, it is quickly vanishing. All over the world, governments are finally writing the rulebooks for crypto. The Wild West days are officially numbered.
And make no mistake, this isn't just a few countries doing their own thing. What we are witnessing is a coordinated global movement. Europe, Asia, the Americas, financial authorities are all working together to build a consistent, worldwide framework for digital assets.
But wow, they have a long way to go. The Financial Action Task Force, they're basically the global watchdog for money laundering, says that a staggering 75% of countries are still not fully compliant with their crypto rules. 3/4. That massive gap is exactly why regulators are hitting the accelerator so hard right now. And here's another key number for you. Almost a third of countries haven't even put the travel rule into effect. This is a basic rule that requires crypto platforms to know who is sending and receiving funds, just like banks have been doing forever. Closing these fundamental gaps is a top priority.
If you want a peek at the future, just look at Europe. They are leading the charge with a super clear timeline.
Major regulations like MiCA and DORA are coming into full force as we speak, and they're setting a much higher standard for the entire industry.
MiCAR, especially, is a total game changer. It's this landmark law that creates one single, unified set of rules for the entire European Union. So once a crypto firm gets authorized in one EU country, it can passport its services to all 27 member states. That creates a massive, integrated market overnight.
Meanwhile, the US is also making some huge moves toward clarity. New laws are trying to finally sort out who regulates what, the SEC or the CFTC. The IRS is rolling out new forms to make tax reporting way less of a headache, and new accounting rules are making things much more transparent. It's all moving in the same direction. Crypto is growing. And right across the channel, the UK is on the exact same path, building its own comprehensive rulebook that's going to be fully in place by 2026. The message here is crystal clear. The entire developed world is moving in lockstep.
Okay, so let's tie all these threads together. We started with a tactical move for your own portfolio, and we zoomed all the way out to global policy. What does this all mean for the future of crypto?
To put it simply, the era of crypto as this unregulated frontier, it's over. The chaos and the uncertainty that really defined its early years are being replaced by structure, by rules, and by clarity.
So here's what you need to take away. First, all this market volatility, as stressful as it is, creates real strategic opportunities if you know what you're doing. Second, that regulatory fog we've lived in for years is finally lifting, and a clear global framework is taking its place. And finally, the future of this whole asset class is going to be built on compliance, transparency, and a much deeper connection with traditional finance.
And that brings us to the final, and maybe the most important question of all. As crypto moves from the wild fringes to the regulated mainstream, what becomes its next great frontier? With this new foundation of rules in place, what truly revolutionary innovations can finally be built? That is the big question for 2026 and beyond.